Hey, what's going on, everybody? Thank you for joining in. This is the Sprint Review. So this is a personal finance show, and it's focused for tech professionals. So I am Mike Zung. I guess try to point to it correctly. I'm Mike Zung. I am a certified financial planner, and I am the founder of Java Wealth, which is a fee-only financial planning firm. I am based in Kansas City, but I work with people virtually all across the country. And the focus for the firm is on tech professionals and all the different things that tech professionals have to deal with. Namely equity compensation, just different things with career, and then a lot of the normal personal finance stuff that everyone has to deal with. So yeah, I really appreciate you joining. And today's episode is an episode show. I feel kind of goofy calling it an episode, but today's going to be a little bit different. I don't have one set topic that I was going to talk through. So yeah, just to introduce it a little bit. Yeah, this one is going to be just what I'm calling a mailbag plus ask me anything episode, where I'm going to be, I pulled a handful of questions that have been asked on the YouTube channel on various videos, and so I figured that I can take this time to give a little bit more of an in-depth answer, because answering inside of comments can only go so far, and I figured it would be good to give it a little bit more time and a little bit more explanation than just a couple of lines that you can put inside of the comments. So that will be the main format of this. And then also, if you are currently on the live stream, then feel free to drop a comment and ask any sort of questions, and so I will see them. I'll see them here, and I can show your comment or show the question and try to get it answered on the spot here. So that's why I say it's a mailbag plus ask me anything related to money. And I guess if you wanted to ask me a question that's not necessarily related to money, then feel free. Okay, so before getting started, then first, it's very important to have this disclaimer. So saying that this video is only general explanations and education. It's not specific tax, legal, or investment advice. And before considering acting on anything you see in this video, first consult with your legal, tax, or investment advisor. Because actually there are a few of these there's a couple of these questions that get into, that talk more about the tax side of it, and also some from the investment side. But it's all financial education. Okay. Yeah, so yeah, just to get started, like I said, all of the questions that I pulled are from previous videos, and so I won't be going into all of the details that I did in those videos. So if there's a question that you want to learn more about it, then I would recommend going back to the original video, looking through that, and then you can come back here, and then you get a little bit more context around what the question is and around the answer. Okay, so just to get started, I am going to start with a question that was around. So there was a video that I did around what the tax benefits are if you have highly appreciated stock and you want to donate to charity. And there's a lot of advantages of doing it that way. And so just maybe a real quick version of it. I don't know if I'll necessarily do the whiteboard yet, but a real quick version is to say that if you hold some stock that has gone up in value quite a bit, and you've held it for longer than a year, that's actually an important piece. If you've done that, then a strategy is to donate that stock directly to a charity of your choice. And the reason being is that if instead you just sold the stock first, then you would be taxed on what's on that gain. So you would get taxed. Most people are in the 15% long-term capital gains bracket. So you would 15% of that would get taxed of the gain. And so what you can do instead is you can donate that stock directly to the charity, and in that scenario, then there is no capital gains on that stock, so 15% isn't taken out, so the charity gets more. And then also from your perspective, you get to claim the full charitable donation amount through that, and so that is a very good strategy and a very wise thing to do if you have highly appreciated stock and you have charitable intentions. You're wanting to donate to charity. So that was the long and short of the video that I did. And one of the comments that was on here was saying that there was a person who said that they're donating some depreciated stock. So the stock has actually gone down in value. And they say, so I assume the charity gets the full market value and I can deduct that as an itemized deduction, but do I still get the capital loss deduction? So for in that scenario, maybe I will. I feel like I think better if I draw things out. So the scenario that we're talking about is someone bought, we'll say they bought $10,000 of stock, right? And so I guess we'll call it that it's $10 a share, right? And then they held it for a while, and then they're wanting to donate the stock. I guess I need to draw my line a little bit lower if it's depreciated. So if it has gone down in value, so they've held it for longer than a year, and now it's at $8 a share, right? No, just the 8. If it's at $8 a share, and so the actual value of it is now $8,000. So in this scenario, if you're wanting to donate, in order to, well, here, let me back up. So if you would donate this directly to the charity, so say we have our charity here, right? So if we have our charity, and if you donate it directly here, then the charity gets $8,000, right? But you never sold it, you never got a loss on it, so in this scenario, if they did that, then you don't get the capital loss deduction. But in this scenario, if your stock has gone down in value and you're wanting to give it, then that is a case where you can go ahead and sell it. So I guess if you're the person over here, so you can go ahead and sell it, and then you get to claim the loss, the $2,000 loss here, right? So then you get the stock, you claim the loss, and then you can give it to the charity. And so basically the answer to that question is if you have stock that has gone down in value, you're wanting to donate to charity, go ahead and sell it first, and then you can donate the money directly to charity, because then the charity gets the same amount of money, and then you also get to claim that loss and lower your taxes. Okay. So that is question number 1 around charitable giving, and I started with that because I'm a firm believer that charity leads everything. Okay. And now the next question that I have, and also I guess pausing a little bit here, if you're watching this live and you have any questions related to that, then feel free to drop any clarifying questions that you have in the comments too. Okay, so the next one is kind of a long one, so it's going to cover up my face. This one is around health savings accounts. So I did a video on HSAs that talk about I called it the power of delayed distributions, or delayed reimbursement, I should say. And the strategy around this is to say you have money in your HSA and actually, I'm gonna hide that for a little bit because it's just so that it's less distracting. The strategy around that video is saying that if you have money in an HSA, so you kind of think of an HSA as this is also another investment account, and it's earmarked for medical expenses. So so if you have money in an HSA and you have a large medical expense, then one strategy is to say, rather than tapping into the money that's in the HSA, you actually leave that alone and let it be invested and stay invested, and instead you pay for that medical expense out of pocket. And then the other side of that is that, okay, you've done that, you're out of the money that you've paid out of pocket, but years down the line, after that seed amount has grown, that the investments have grown, then you can use basically the receipts or the records of that medical expense, and you can use that in future years to withdraw that amount of money and it be tax-free. So that's the delayed reimbursement strategy. And so with this question, the first question said, so if I have a medical bill of $2,000, is it better to wait 1 year or 30 years to claim that reimbursement? And so my response there is just saying that the longer that you can keep it invested, then the better it is, just from an investment compounding interest perspective. And I give an example that says that if that $2,000 was invested for 30 years and earning 8%, then it becomes $21,000 in the HSA. And then after 30 years, you can take out that $2,000 from the expense from 30 years ago, and then there's another $19,000 that is in your HSA that otherwise wouldn't have been there if you would have used the HSA money whenever the expense actually happened. So yeah, so that's the initial response to, like, is it better to wait 1 year or 30? So it's like the longer the better. Okay, and then as far as the next question, it gets a little bit more into the nuts and bolts of how this actually works. So skipping down to to this, she says that that they opened the HSA and got laser eye surgery, and then use the credit card to pay the cost out of pocket. So they've already paid for the actual expense, the medical expense, and so the money is still in the HSA. And so the question here is saying, I'm unsure when it's most beneficial to me to claim the reimbursement. If I claim for the amount of the surgery next month, hypothetically, would this amount be added into my HSA, as I've already paid off the amount and have receipts to prove it? I'm confused over how this amount will still be deducted from the HSA. Okay. And so to that point, it's not like you would get, so basically what you're doing is you're reimbursing yourself. So in this example, to say you're here, you have your HSA. I won't do the larger one. I had one that had a little red cross and everything inside of the actual video. And actually, let me give you a closer look. Oh, and give you some arms too. So if you would put $2,000 into here, or we'll say you had $2,000 in your HSA, and then you had a medical expense that you paid out of pocket. So we'll say that you paid $2K also out of pocket, right? And so the money in the HSA is going to stay invested, and I'm going to use these arrows to say that it's staying invested and that it's compounding, that the value of this is growing, right? And so what the question is to say, like, okay, how do I then claim claim that $2,000 as, how do I get reimbursed that? And essentially, in this scenario that we're talking about, to where this $2,000, it grows to 21,000, right? I mean, essentially, what you would do in that example, 30 years down the line, is that you could just go into this HSA and then you withdraw money from the HSA and you transfer it into your own account, right? Into your own checking account. And so you're reimbursing yourself. There's nothing that's involved with the hospital or anything like that. Here's my hospital. There's no sort of reimbursement that you're doing from there. You're just taking money. You're taking this $2,000 out of your own HSA and putting it into your checking account. And just from a record keeping perspective and from a tax perspective, whenever you file your taxes and say, hey, $2,000 came out of my HSA, then you can just say, and here's the receipt that I have, here's the records that I have to prove that that was a qualified expense. So, yeah. So yeah, as far as how you get reimbursed, it is just you go into your HSA and you say, I want to do a withdrawal. And I actually did this just before this video, just to do a little bit of extra homework. I went into my HSA and started to go through that process, and the fields that it had me fill out was saying that how much you want to have withdrawn, the date that you want to withdraw it, and then you can add records to say the date of the procedure or of the date of the expense, and then you can put an invoice number for just from a record keeping perspective to say, so that you can explicitly connect the dots of this money was a reimbursement of this particular expense from 30 years ago. Okay. All right. Now, next we're gonna get into some more. This is where it gets to the tech professional specific stuff. This next question is around AMT. So I did a video on incentive stock options and talked about how they work and how they're taxed, and the possibility of triggering AMT for options for ISOs that you exercise but that you hold through the end of the year. So again, it's like an 8-minute long video, so I'm not going to try to summarize it here. But the short version is that if you have ISOs that have a big spread, that whenever you exercise them, you can very easily trigger a lot of AMT. And I guess one of the other pieces of it to say that whenever you owe AMT on ISOs, then there's something called the AMT credit that you're able to carry forward indefinitely and use that credit to basically get that money back that you paid in the year that you triggered AMT. It's way more complicated than that, and it's not 100% necessarily, and so I won't go into all the details, and this is where I need to lean on the disclaimer too, saying that this is not tax advice, and consult your tax professional for any of the details of this. So this person said, if AMT credit can be used indefinitely, so yeah, that credit doesn't expire, it can be used indefinitely, then why is it considered unwise to tip into AMT? Is there a limit on how much can be used per year? And I thought it was a really good question and a really interesting point, in that on its own, triggering AMT on ISOs is not necessarily a bad thing. Yes, that credit is going to, you will recoup that money, generally speaking, in future years. But whenever it comes to the actual implementation and from a personal perspective, one of the main things to plan for is understanding how much AMT you're going to have and whether you have the cash to pay it. It's less a a numbers financial planning problem and more of a cash flow problem. More of just like, hey, I am going to have to front tens of thousands, possibly maybe even hundreds of thousands of dollars up. I'm going to have to pay taxes on that in a concentrated period, and I might not have the availability of those stock options. I might not be able to sell those stock options yet to actually pay that bill, and so I'm going to have to come up with the money somewhere else. So that's really the biggest one of the biggest things to think about whenever you're triggering AMT, to say, okay, how much is it that I'm triggering, and where am I going to get that money? Because I do not subscribe to having that level of risk to where you have to borrow in order to pay for the AMT with the with the plans of, oh well, I'll be able to sell it later so I can pay back that loan. Because in that time period, we're talking about being concentrated into a single stock, and so that's a very risky proposition to pay AMT with debt that you're going to take on, and it's not money that you already have. And we don't want to be tapping into retirement accounts. We don't want to be tapping into emergency funds or anything like that. And so really the triggering AMT is as much, it comes down to a cash flow thing, to say that, like, how are you going to pay for it? And one strategy that I've touched on in the past with AMT is getting it whenever if you can exercise your ISOs at the beginning of the year, then in that case you're able to here, maybe I can draw it real quick. So if this is a calendar year, so we're in 2021, right? And so if in 2021 you exercise your ISOs here at the beginning of the year, and we'll say you did it in February 1st, that you exercise here, then your AMTs are going to be due on tax day of 2022, right? So this is whenever AMTs due, right? And so the strategy is to say, if you exercise here, then you can still satisfy the 1 year holding period to make it a qualifying disposition. Again, go back to the other video and you'll get all the details of it. And then you can sell the stock that you've created from exercising this ISO, and then you can use the funds there to pay for the AMT. So that's one of the strategies of why it's nice to exercise early in the year, because you can solve this cash flow problem of how am I going to actually pay for the AMT. Again, you are taking the risk of that single stock, but yeah, so that's the logic behind that. Okay. All right, just chugging along to the next one. This is another ISO one that gets a little more into the just the weeds of it, and from a tax reporting perspective. And so someone had asked, is it normal for the company to report the exercised stock option amount on box 1 of a W-2? So box 1 of your W-2 that's where your salary is. And then they said that the rest of the W-2 is blank. And so in this scenario, if you just exercise your stock options, that's not considered W-2 income yet. And so I didn't add the rest of this conversation, but the only amount that's in that spot that's part of ordinary income is any ISOs that you exercise, but then you also sell within that same year. And so that's called doing a disqualifying disposition, and then that amount will be added to box 1 of the W-2. So in this person's example, I asked the question of, did you get two W-2s from the same employer? And they did. And so what the way that it was reported is that they had one W-2 that was, kind of the more classic standard one where like it has your wages and it shows, how much was withheld for Social Security and Medicare and all that good stuff. And then the company issued a second W-2 that says, here is the income that you created on your ISOs that you exercised and sold within the same year. But that's not how all companies do it necessarily. Another way is that the one W-2 will have both their salary, bonus, and any disqualifying dispositions of ISOs. And then as a quick side note, that the reason why it's important to understand these tax documents is that it'll get reported there, but then you'll also get another form that will show short-term capital gains. So you'll get a 1099 and it can show short-term capital gains on that same thing, and it's very common or very easy to double report the same income, and you're creating a larger, you're over-reporting how much money you earned. So whenever it comes to ISOs, I definitely recommend that people seek professional tax preparation help, because it is very easy to get it wrong, to kind of mess it up a little bit. So yeah, that's that part. And then also just real quick, if you do exercise ISOs and you hold it through the end of the year, so it's part of that AMT, then there's a separate form that your company will submit to the IRS that says, here's all of the ISO. It's called bargain element. Here's all the ISO bargain element that kind of carried over to the next year. All right, that one was a little more in the weeds. Okay, this one's going to be a lot lighter. Yeah, so this is the last question that I have that I'll be that I will be answering, and then of course, unless anybody else has something. And so before showing this, so what I'll do sometimes, usually whenever I'm procrastinating or in some kind of avoidance behavior, is I'm part of a few Facebook groups that are focused around personal finance, and so I'll just look to see what questions people are asking and some of the responses. And so there was one that is it's a Vanguard, it's like a fans of Vanguard group that's on Facebook, and the question was asked that says, where do I put $250,000? So someone says, I have $250,000 and I want to get 3 to 5% return, and then I have 18 months and I want low risk. And then one of the responses was this ticker, this VTSAX. This VTSAX has become like people swear by it. Is like, this is the one investment that you need. There's the saying that says VTSAX and chill. And what this one investment is a total, it's called the total stock market index. And so under the covers, what it is it's trying to say, like, this one investment is 3,000 companies, and they're all U.S. based companies, and it's very heavily, it's called cap weighted, so it's skewed towards the large companies. So I think I looked up that said that the top 10 companies in this index make up 20% of the overall index. But it goes to a very interesting phenomenon where the stock market, the S&P 500, this VTSAX, it has done very well for it's been on a run, like a long, called bull run, right? And it's gotten to the point where people are they're no longer seeing the risk in being invested in in the stock market. And yeah, so from from the perspective of like, I have 18 months and I need low risk and I want 3 to 5% returns, honestly, something just has to give in these parameters, because the low risk, risk free is is whatever the 10-year treasury is. So it's like, I didn't look it up, but it's under 1% for sure. And so the idea of like, hey, I just need to park money and have it low risk, and expect 3 to 5% returns, that's just not possible. Just being completely frank. I mean, you could do something, if you did something like this, then yeah, you might get 3 to 5%, you might get 12%. Shoot, I mean, in the last 12 months, I think this probably went up 90%, from the bottom. But it's by no means low risk. I mean, this index it's all stocks, right? There's no bonds, it's all the stock market. And so yeah, and that's why that kind of cracked me up. And you see here that there's the likes. There is someone laugh and sad, but most of these were likes. And so that does get a little bit into where how to be careful, that you need to be careful in where you're looking for financial education or advice, and that just talking to people on social media, yes, there is good advice, but or good education, I should say, and then there's also just bad or dangerous stuff that's out there. So I mean, from my perspective, whenever I'm working with any clients, whenever if it's for if it's doing something that is less than 2 years, so like in an 18-month time period, then I say it's like, we're not going to try to mess with the stock market or anything like that, and just park it in a high yield savings account, and that you're just focusing on saving. Right? So yeah, I thought that one was a pretty interesting one. All right. And then the last one actually isn't a question, but I guess maybe I'm just I'm patting myself on the back, but it's a comment that I got from the ISO video, and it's someone that said that they were studying for the CFP exam, and said that the visualization of the grant, exercise, and sell was a huge help, and then the ISO question came on the exam, and then she got it right. So that I don't know, I just had to share it because I felt like it was, I mean, it's a really cool thing to, like, I'm doing this to try to give financial education from a just for the larger public, namely people that are in the tech space. But then the CFP is Certified Financial Planner, so that's the exam that I took, and it's the primary marks for financial planning. And so to see that and say, hey, they're studying for the CFP and use the video, then I just got to say it gave me the jellies. So okay. Yeah, I mean, I think that's it. You guys are quiet, so then I guess I can hang out for another minute or so. But outside of that, that's what I have. The show in a couple weeks, I'm going to have a guest on the show, and we're going to be talking about things to think about whenever you are having a baby, and so just kind of the different planning around. The different things that you need to plan for. We'll touch on some 529 stuff, and I'm really excited. So yeah, and actually for the next few weeks I'll be doing more of that interview style. So I did one with Keith Spencer. I guess it was about a month ago now, maybe a little bit more, talking about whether or not you should buy a house right now. And that one was a lot of fun, and so I figure that I'm going to be doing a lot more of that interview style and less, talking to the whiteboard stuff. So okay, yeah, I think that's it. If there's no other questions, then I appreciate you guys coming on, and if you want to keep following along, then just subscribe to the YouTube channel. And if you have any more in-depth questions, then feel free to reach out to me. My website is javawealth.com. And otherwise, I will talk to you guys later. All right, see ya.